Your credit score is important. The higher your credit rating, the better your chances of being accepted for credit at the best rates. It can influence your ability to get things like credit cards, loans, mortgages, mobile contracts, and more. What is a credit score? At its core, a credit score is a numerical representation of your creditworthiness. It is a measure of how likely you are to repay borrowed money based on your past financial behavior. Credit scores typically range from 300 to 850, with higher scores indicating a lower credit risk and vice versa. Lenders, such as banks and credit card companies, use these scores to evaluate the risk of lending money to individuals. Factors influencing your credit score. Several factors contribute to the calculation of your credit score, with varying degrees of importance. The most common ones include payment history. Your payment history is the cornerstone of your credit score, carrying the most weight in its calculation. Consistently making on-time payments for loans, credit cards, and other debts demonstrates reliability and financial responsibility to lenders. Conversely, missing payments or making late payments can have severe consequences, causing your credit score to plummet. Even a single missed payment can tarnish your credit history and take years to recover from. Credit utilization. Another vital factor in determining your credit score is your credit utilization ratio. This ratio measures the amount of credit you're using compared to your total available credit. Keeping this ratio low, ideally below 30%, shows that you're not overly reliant on credit and can manage your finances responsibly. Lenders view a low credit utilization ratio favorably, as it indicates that you're not living beyond your means and are less likely to default on your debts. Length of credit history. The length of time you've been using credit is also crucial in assessing your creditworthiness. Lenders prefer borrowers with longer credit histories because it provides more data to evaluate their financial habits and patterns of behavior. A lengthy credit history demonstrates stability and reliability, suggesting that you have a proven track record of managing credit responsibly over time. While it's not something you can change overnight, maintaining a long-standing credit history can positively influence your credit score and enhance your financial standing in the eyes of lenders. Types of credit. A diverse mix of credit accounts is another factor that can impact your credit score positively. Lenders like to see that you can manage different types of credit responsibly, including revolving credit, like credit cards, and installment loans, like mortgages or car loans. This demonstrates your ability to handle various financial obligations and suggests that you have experience managing different types of debt. However, it's essential to maintain a healthy balance and only take on credit that you can comfortably manage. New credit inquiries. Whenever you apply for new credit, whether it's a credit card, loan, or mortgage, a hard inquiry is recorded on your credit report. While a single hard inquiry may only have a minor impact on your credit score, multiple inquiries within a short period can raise red flags for lenders. It may indicate that you're taking on too much debt or facing financial difficulties, potentially lowering your credit score. That's why it's crucial to be strategic about applying for new credit and only do so when necessary. Additionally, some credit scoring models may treat rate shopping, such as for a mortgage or auto loan, within a specific time frame as a single inquiry to minimize the impact on your score. Understanding how inquiries affect your credit score can help you make informed decisions about when and how to apply for new credit. Strategies to boost your credit score early. Now that we understand the factors influencing credit scores, let's explore actionable strategies to enhance your score from the outset. Establish good credit habits. Developing responsible credit habits is essential for maintaining a healthy credit score. Consistently making timely payments on all your bills and debts demonstrates reliability and financial discipline. Even a single missed payment can have a significant negative impact on your credit score, so it's crucial to prioritize paying your bills on time, every time. Keep credit utilization low. Your credit utilization ratio, which measures the amount of credit you're using compared to your total available credit, plays a crucial role in your credit score. Aim to keep this ratio below 30%, ideally even lower if possible. Paying off your credit card balances in full each month is an effective way to keep your credit utilization low and demonstrate responsible credit management. Avoid maxing out your credit cards, as high credit utilization can signal financial distress to lenders and negatively impact your credit score. Monitor your credit report regularly. Regularly monitoring your credit report allows you to stay informed about your credit status and detect any errors or inaccuracies that could be dragging down your score. Request a free copy of your credit report from each of the three major credit bureaus, Equifax, Experian, and TransUnion, at least once a year and review it carefully for any discrepancies. If you spot any errors, report them to the credit bureaus immediately and follow up to ensure they are corrected promptly. By following these proactive strategies and adopting responsible credit habits early on, you can establish a solid foundation for building and maintaining a healthy credit score. Remember that good credit habits take time to develop, so stay patient and persistent in your efforts to achieve financial stability and success. Become an authorized user. If you're just starting to build credit, becoming an authorized user on a family member's or friend's credit card can help establish a positive credit history. Ensure that the primary cardholder has a good payment history and low credit utilization. Utilize credit-building products. Consider alternative credit-building products such as secured credit cards or credit builder loans. These products are designed for individuals with limited or damaged credit and can help you establish a positive credit history. Practice patience and persistence. Building and improving your credit score is a gradual process that requires patience and persistence. Stay disciplined with your credit habits, and over time, you'll see your score rise steadily. The importance of starting early. Why is it essential to focus on boosting your credit score early in your financial journey? The answer lies in the long-term benefits and opportunities it unlocks. A high credit score not only makes it easier to qualify for loans and credit cards, but also translates into lower interest rates and better terms. This can result in substantial savings over time, whether you're buying a car, purchasing a home, or financing your education. Moreover, a strong credit history lays the groundwork for future financial endeavors, such as starting a business or investing in real estate. It enhances your financial credibility and opens doors to opportunities that may otherwise be out of reach. Your credit score is a powerful financial tool that can either work for you or against you. By understanding how credit scores are calculated and implementing proactive strategies to improve yours early on, you can set yourself up for financial success and security. Cultivate good credit habits, monitor your credit regularly, and be patient as you work towards achieving and maintaining a stellar credit score. Remember, the journey to financial empowerment begins with a single step, and mastering your credit score is a crucial milestone along the way. Thank you for watching, and don't forget to like and subscribe.